Welcome back. Welcome back to our YouTube channel. Today, we're going to talk about a couple of main things. One of the main things I do want to talk about today is we're going to go through a loan estimate. I'm going to go through every aspect of a loan estimate, all the details. Next, I want to talk about when you guys get a loan estimate and then you get a loan estimate from another lender, and this is specifically for a purchase transaction, how to compare two loan estimates. You're looking at how do you know which one's better? So we're going to go through that. And I do have an audience member here that'll be asking me questions. And hopefully some of these questions that she asks are some of the same questions you guys are kind of asking in the audience. Now, anyway, let's get right to it. So when you guys first get your loan estimate, your loan estimate it's a 3-page document that's going to describe, all estimated fees and things of that nature, that are estimated fees, interest rates, your monthly principals, your payments, and just kind of everything that goes into a loan. And that essentially is a loan estimate.
Why are loan estimates so important?
I mean, loan estimates are important for you guys as consumers or clients to get an idea of what the estimated cost can be. What the estimated cost, what the estimated payment can be. Just exactly kind of the nature of the topic, the loan estimate. But I want to reiterate that a loan estimate, it actually is just an estimate. So this isn't final. So a lot of people will look at their loan estimate and be like, they will think that it's actually a final estimate. So before we start talking about the fees, there's a quick thing that I'd like to point out, that a lender on a loan estimate may over-exaggerate their fees. Now you're going to ask, why do they over-exaggerate your fees? I was going to get in this later in the video, but we could just talk about it now. The thing is, if I don't over-exaggerate your fees, let's just say, for example, you have to pay a transfer tax to the city that you guys are buying in. Let's say you're buying in, whatever you're buying in, Los Angeles. It doesn't matter what city. Some cities have transfer taxes. We've had this issue come up before. If I don't tell you that your transfer taxes cost $1,000, then I literally have to pay your transfer taxes. Am I buying the house? No. Am I responsible for the tax? Theoretically, yes, if I didn't tell you about it. They put a lot of pressure on lenders now since this loan estimate was created, and TRID was the rules that are kind of behind this. They were created, I believe, in 2015. A little bit after the crash, they kind of got things together, and this is the new thing out. It's called, literally, like I said, it's called the loan estimate. But I think that's one of the stupidest rules that are out there, because we don't benefit off that, right? I don't benefit off of your taxes on a transfer tax on your property that's higher than what we thought it was. We literally get in trouble. Not in trouble in a sense. We lose money. This is a business, and at the end of the day, so if I put your transfer taxes really high in your loan estimate, I always tell them, a lot of my clients, they do trust me, but for not everybody trusts everybody these days. So if you don't trust somebody, the reason that it's high is because I literally have to pay for that. If I don't get the final word from the county, I have to pay for that. Or, again, we're going to get into other sections. I want to kind of move on, and I'll show you other examples of reasons and things that we basically need to watch out for as a lender, because if we don't over-disclose to you, we basically have to eat it. So essentially, you get your loan estimate. The first page is your basic information, the date it was issued, the applicants, your sales price. So you guys want to ensure that all information is correct in terms of the spelling of your name, the sales price. Sometimes, this is all data entry, so people can get this wrong. Your loan type, your product type, most of the time that's product type on the top right corner of your loan estimate. It should say fixed. 95% of the loans that are in the United States these days, they are fixed rate mortgages. Loan term, again, probably 90%, 95% of the loans are also 30-year loans. Do you have any questions?
Yeah. When should I receive a loan estimate?
You should get a loan estimate 3 days after an initial application has been put in. 3 business days, I should say. So you guys should get a loan estimate, I would say, like right after you guys enter escrow. And the loan application is not finalized until I have a purchase address. So usually I'll do a pre-approval for you and we'll complete your application. You guys are not due a technical official loan estimate until we have an address tied to that property that we put into our system. At that point, we're on a 3-day business clock window to release a loan estimate to you. And a lot of times I go back to those exaggerating of fees. The reason I exaggerate the fees is because your escrow company or your title company or your attorney in some states hasn't told me what they're charging you. So if they haven't told me what they're charging you, I have to overestimate because I literally have to pay your escrow. Again, we'll get into that issue later. That issue kind of bothers me, so that's why I'm kind of harping on it a little bit. Okay, again, yeah, the first page will have, again, top part of the page, guys, it'll have basic information, your information, like we just talked about, things of that nature. The other one, the next thing is going to be your loan amount. Your loan amount is, obviously going to just be your loan amount. And then right next to your loan amount, it's going to say, can this amount increase after closing? So if that thing says yes, run. At that point, you have what's called a negative amortization loan. They're really not offered. So if that thing says yes, can your loan amount increase after closing? Either you have a reverse mortgage, and they don't even use this, but it would be either a reverse mortgage or some type of strange, funky loan product that only a handful of people on the market even still have today. And honestly, it's hard to get those kind of loans today. But anyway, if your loan amount next to it says, can this increase after closing? If it says yes, run away. Next thing would be interest rate. Again, can this increase after closing? If you're getting an ARM, that answer should be yes. 5 to 10% of the loans that you guys do right now are going to be ARMs. That should say yes. The next one is monthly principal and interest. That is your actual mortgage payment. So and if it's fixed, that's the payment that you're going to pay every month to the bank for just the mortgage. Does not include taxes, insurance, HOA, and it does not include mortgage insurance or anything like that. It's just the actual mortgage is going to be monthly principal and interest. The next thing is prepayment penalty. Prepayment penalty is a penalty that you pay if you guys are getting some type of investment loan. Just really quick on prepayment penalties. If you guys are getting an owner-occupied or a second vacation home, prepayment penalties are no longer allowed in the market. So you will not have a prepayment penalty. If you ever buy a primary home, those are consumer transactions and they're not allowed in the United States for primary homes. Did you have a question?
Yeah. What determines what rate I get? What factors determine it?
What determines what rate you get? That's a good question. A lot of factors obviously determine what rate you get. I would say number one, it's going to be your credit score. Number 2 is going to be the amount of money you put down. And then number 3 is going to be the program that you guys are qualified for. So your credit score, the amount of money you put down, and the program. Those are the main 3 factors that are going to determine your credit score. Getting back to the loan estimate, the next thing is a balloon payment. A balloon payment is essentially a payment that you have to pay if the loan ends. So the balloon is basically a balloon, pop. Your loan essentially is going to go pop, and all the money is going to be due at that time. At a certain time, if your loan has a term, let's say you have a 12-month loan. After the 12-month, that's technically a balloon, and that should say yes. It would only be on investment properties. Investment properties have a lot of features on loans that basically where that would kind of factor in. Again, the next thing is going to be your projected payments. Projected payments are exactly that. Your principal, your interest, your mortgage insurance, and your estimated escrow. We're going to get, and it says your amount can increase over time under estimated escrows. Now, I'll get into this a little bit later because escrows are a kind of a tricky subject, and we can talk about it basically a little bit later in this video. And the next is your estimated taxes, insurance, and assessments. That section is going to be everything, your taxes, your insurance, and assessments. Usually, guys, that's going to be HOA. When it says assessments, usually people these days have HOAs, and your HOA is going to be included in that. So if you guys see a big number in that section, it's going to be your HOA. And then right to the right of it, it says in escrow. That means, is it included in my mortgage payment? If you have what's called an impound account or an escrow account, then your taxes and insurance are going to be included in that payment. And they should say yes under the loan estimate where it says in escrow. The next thing is going to be your estimated closing costs. The estimated closing costs are just that. Those are lender fees, title fees, escrow fees, notary fees, your prepaid interest, any transaction coordinator maybe you're paying, your termite inspection, things of that nature. And then your estimated cash to close is essentially that. How much cash it's going to take for you to get those keys. How much cash left to close on the deal, get your keys, and get into your new property. So that's basically the first page, and the first page is essentially a summary page of the loan estimate. And then the second page is essentially all the charges that are going to be estimated to be associated with the loan that you guys are getting and with the home that you guys are getting. So any questions so far? No, you're good? Okay. So Section A. Okay, so Section A is the origination charges. I want to harp on Section A because in Section A of a loan estimate, that is the only place on a purchase transaction that a mortgage lender or mortgage broker really has control over. So Section A is the only section a broker or a lender has control over on a purchase transaction is Section A, which is the origination charges, which is pretty much how much they're charging you for their services. Usually people have administration fees, processing fees, underwriting fees, origination fees, of course, and then points. Points are money that you pay to buy down your rate. And those would be in that section. So anything a lender controls, any fees a lender controls, it's going to be in that section, Section A only. Section B, sorry, you had a question?
Yeah. To buy down the rate, does the cost change?
Yeah, that's a little bit complicated question, but yeah, I mean, say it again?
Yeah. So what determines the cost of buying down a rate?
What determines the cost? I mean, it depends on the rate. So every rate and every investor has a different percentage on a different rate. So for example, buying down 0.25% might be 1 point, but buying down 0.5 point might be 3 points. So they're never even. You can never buy down a rate at the same percentage point. So just because you paid 1 point to buy your rate down 0.25%, so 0.25, you would think that it would cost you 2 points or 2% of your loan amount to buy it down 0.5%, but that's not true. So every rate comes with a different money factor, you could say, or a different price. They're not all the same price. And it depends on the day that you guys are locking. It depends on the market at the time and things of that nature. And sometimes, for example, a rate at 7.125 might be a little bit better than a rate of, it might be better than a rate of a higher rate basically. Because I was doing a loan. I was pricing a loan out recently, and the lady was literally getting. I was able to give her a lender credit at a 7.125% that was more than a 7 point. So I give her a lower rate and a bigger credit because some rates just pay better. The market is telling you that's the rate that they want to give. So.
How can you determine when to give a lender credit?
Oh, that's going to depend on so many factors in terms of somebody's loan it's the same factors that comes with your rate is going to be so a lender has a certain compensation that they make. Let's say a lender would make 1% on your loan. Anything after the 1% they'll give you as a credit. So, but that would again depend on what rate you're getting and what your factors are determined in the rate. And, if the lender's giving you some type of incentive and they're working for less. There's a lot of factors in that. That's like more of a, that wouldn't be like a consumer thing. It would more be like an internal thing. Depending on the lender, they'll determine where that kind of plays out. Anyway, I finished section A. Section B on your loan estimate, it's services you cannot shop for. And the reason you cannot shop for, it's things that you literally have no control over. So an appraisal fee has to go through whatever lender you're working with. They order it through a third-party service provider. You can't shop for that. You can't shop for your credit report. Your credit report is in that section. If you're getting a VA loan or you're getting an FHA loan, VA and FHA loans have something called MIP, mortgage insurance premium, or VAs have, they call it a funding fee. It's the same idea. It's a fee added to the back end of your loan to support the government program. You can't shop for that, and they're non-negotiable. That's why they're in that section. And those are kind of the main things that you're going to see in Section B. Again, services you really just cannot shop for. And again, that's why the lender doesn't have any control over Section B. They're from third-party service providers that they don't even have control over for the most part. Like they don't have any control over they do have a little bit of control over your appraisal. They can choose which appraisal company kind of fits your property the best and things of that nature. But for the most part, these are service providers and they have their own charges. Section C, and especially on a home purchase, Section C is going to be your escrow fees, title fees, and then lawyer fees in some states. Depending on the state that you're in, some people are in attorney states. Those fees are all going to be in that section. And that section, again, they're fees that have nothing to do with the lender, especially on a purchase, because I didn't choose what escrow company you guys are using. I didn't choose the title company, and I didn't choose the closing attorney that you guys are using. So these are fees, again, that we essentially have to estimate for you. We do get their fees. That's why I like to wait for that person to tell us how much they're charging you before I put it on your estimate. Or else I'll just have to overestimate the fee because, again, if I don't overestimate your closing costs in terms of escrow fees, your settlement agent, and your title insurance and things of that nature, I literally have to cover them. So I'm not interested in paying your fees. I'm interested in running a business, and we can't run a business if we're just paying for everybody's fees. So we're trying to get that number as close to correct as possible. That's Section C. Section E, government fees, and that's where the transfer taxes go that I talked to you guys about earlier. The transfer taxes are in Section E, and any other government fees, recording fees, county fees, anything essentially related to the government, that goes in Section E. Prepaids. Oh, sorry, you had a question?
Yeah. Does every purchase transaction have a transfer fee?
No, not ever. To be honest with you, most transactions do not have transfer taxes, especially in the state of California. And also in the state of California, they do have transfer taxes, but I would say 95% of the time the seller pays it. So the buyer's usually not responsible for transfer taxes. So it doesn't really come into play in California. I know that it's big in Florida, but in California, it doesn't come too much into play. So that's your Section E. That's your government section. Prepaids. Prepaids are kind of a big one. Anytime you guys do buy a home, whether you guys are including taxes and insurance in your payment, you do have to pay a year of home insurance up front. That's going to go in Section F, and that's your prepaid section. You have to pay the year of home insurance in that section. It's really non-negotiable. Got to pay the year of home insurance. You guys want your house covered, especially when you're getting a mortgage. That goes in that section. Another thing is prepaid interest. So what is prepaid interest? Prepaid interest is interest that you pay on your loan the day that you close your loan until the end of the month. For example, if you guys are, let's just say today is the 15th of the month and we have 30 days left in the month, that would mean that there's 16 business days to get to the first of the month. So that on the prepaid interest section, that should say 16 days of interest. So the day you close your loan is the day you got to start paying for your loan. And if you guys don't already know, mortgages are paid in arrears. So mortgages are kind of like, you play before you pay. So essentially you are playing, you're living in the home, then you pay for it in behind, mortgage or paid in arrears. So for example, if we're in June today, your June 1st payment is actually paying for May. So that's why people say, I want to skip a month. Nobody skips a month. You never skip a month. It's just a mortgage gimmick that they put out there, that the refinance guys put out there. You're never skipping a month. Every day you're living in your house, you pay daily interest on that loan. You owe loan, you owe money, you're paying money for it. This isn't free. Life's not free. And as my buddies like to say, nothing is free in life. So you'll pay eventually. You'll lag the payment, whatever you want to do, whatever little gimmick your lender is trying to pull on you, you're going to pay eventually. We can lag it if you want. We can play that game. I don't like to play the game. There's no point because you'll pay it eventually. But maybe for some business owners, we could play a little game with that. But I could talk about that more in detail later. So that's your prepaid interest. Again, it's non-negotiable. But if you do close on the last day of the month, that's why we like to close on the last day of the month. Your closing costs drop dramatically because you're only paying 1 or 2 days of interest on your loan. And then your next payment won't be for another 30 to 45 days because you have until the 15th of the next month to close. To make a payment. So at that point, you've already been in the house for 45 days. So that's basically the prepaid section. The next section is section G. That is going to be your initial escrow payments at closing. That is your impound account. Section G is your impound account. And Section G, if you guys have taxes and insurance included in your payment, Section G is you paying into your escrow account or your impound account. Now I know you had a question on that, I think, before.
Yeah. What's all of the costs that are in the impound account?
Well, the costs are essentially just that. So anytime you guys get an impound account, you have to pay your taxes and your insurance. They put essentially, you could call it a savings account. You put your taxes and insurance into that account so the lender then can make the payment in the future. So in Section F, you paid 12 months of your home insurance. Now in Section G, they're going to want 2 to 3 months of the home insurance in there after you paid the 12 months. Why are they going to want 2 to 3 months extra? So now you're essentially paying 15 months to close escrow, right? And to close on your home. The reason being is every month you make a payment. So now at the end of the year, you now have, again, 15 months of that payment. So in case that payment goes up by a little bit, because unfortunately, insurance has been rising rapidly these days, and insurance will probably always go up forever. Unfortunately, it is what it is type of thing. They have a little bit of a cushion. So they have a 3-month cushion. So when I go pay your insurance company, I have 15 months now saved up of your old payment. But now the new payment came, and the new payment is 15% higher. So technically, I need a little bit extra. So that's what those extra 3 months you're paying are for. They're just essentially a cushion in case the prices do go up on your home insurance. And the same thing happens with the taxes. Taxes are paid twice per year, and we want a cushion. We want a cushion in case the taxes go up. And of course, taxes go up every year, on the year, non-negotiable. Talk to your county supervisor. So there's nothing I could really do about that. And then Section H is going to be things like your owner's title policy, a termite report that you paid for. It's going to be things like your real estate transaction coordinator. Sometimes they have those. That's going to be Section H of your loan estimate. And again, these are things that we don't really have any control over as a lender. So it's hard to, I'm literally responsible for estimating everybody's fees. So I don't know why they put it on us, but it is what it is. Sometimes I wonder, why don't escrow companies just release this? Why don't we tell our fees to an escrow company or a title company, and they release to you your closing estimate? We don't need to call it a loan estimate anymore. It could be called a closing estimate. Because they make us responsible for all these fees that we literally have zero control over. Yeah.
So do lenders control closing costs?
Yeah, that's a big question. It's something I really wanted to talk about. So all in all, when you guys are purchasing a home, lenders do not control your closing costs completely. As I talked about before, a lender only controls Section A. So that's the only section that that a lender is going to control, is going to be Section A. Other than that, that's literally the only thing we can control, is going to be Section A. As far as the other costs, we don't control any of the other costs. Section B, C, none of the other costs we control. So that's why it kind of bothers me when, like, somebody will ask you what are the closing costs. I can give you an estimate. This is what we do. I get it. But at the end of the day, when you guys are going to go out there and you're going to go compare one lender to another lender. So the only thing you guys really can compare when you guys are purchasing a home is Section A. Obviously, your interest rate and things of that nature that we talked about before, but the actual charges that somebody's charging you, it's only Section A. On top of Section A, the lender can give you something called a lender credit, which is going to be the bottom of Section J on your loan estimate. So Section A and then Section J, there's a lender credit, possibly. A lot of times you don't get a lender credit, but if you do, it would be on that section. And that's essentially the first 2 pages of your loan estimate. And then your last page of your loan estimate are just a few other things, like how much you're going to pay in the first 5 years, your actual APR. Your APR is essentially all the fees that you guys are kind of getting into your loan plus your interest rate. So if you guys are paying you have a really low interest rate, but you have high fees, the spread between your interest rate and your APR will be much higher. If you're getting a really low fee loan and your interest rate is what it is, for example, your interest rate is 6%, and if you pay zero cost, your APR should be 6%. But anytime you're purchasing a home, you will pay some cost. So technically your APR will be somewhere above 6% if your interest rate is 6%. And the last page of the loan estimate, just a little more, just kind of like small little disclosures and things of that nature that kind of explain themselves. There's a bunch of things you guys could read about, like if your payment is more than 15 days late, like how much are we allowed to charge you, things of that nature. They're very self-explanatory if you kind of just read through them. But I kind of went through the loan estimate. Another thing I guess I'd like to add is on an FHA loan or a VA loan, that FHA MIP or that VA funding fee, it does get added to the back of your loan. So if you guys are looking at your loan amount on page 1 and you're like, why is my loan amount so high? I'm paying, on a VA loan, you're paying 0% down, or on an FHA loan, you're doing probably 3.5% down, but then your down payment isn't adding up because in Section B, look for that government fee, that FHA mortgage insurance premium or the VA funding fee. It's added to the back of your loan. It is raising your loan amount. It's just, again, it's the nature of the program. It's how they keep the program alive. And it does technically take some of your equity. You don't pay it up front. It is part of your closing cost, but you don't pay it in cash. You pay it over the course of 30 years usually. So that's pretty much it. I kind of described the whole loan estimate. In there, we went through every single section. Now, I don't know if you have any more questions, but I think we kind of covered. Are you good?
We're good.
We're good. Okay. So again, guys, I think we described the whole loan estimate to you guys. You guys can reach out to on my page if you have any more questions. And if you guys want me to compare a loan estimate that you got from another lender, you can just send it over to me. My number is in my profile, and maybe we'll put it down here below on the screen. Just call me. We can go over your loan estimate in more detail. Me and my team will go over it, and we'll try to get you the best deal possible. Of course, comment, like, subscribe, send it to your friends that want to talk about loan estimates. Anyway, thank you. Over and out. Peace.